Hi, this is Bill Moreland with Bankreg Data. Today I'm going to take a quick look at Merchants Bank of Indiana. They just filed yesterday. We got a couple more days left, but yesterday was 900. Probably be tomorrow about 1,200, 1,500 banks filing Q3 call reports. So we're starting to get that new data in. And I wanted to talk a little bit about Merchants Bank. It's a $19 billion bank in obviously Indiana, and essentially it is having some issues, and it's been consistently having issues. This isn't just a one-off, and so I want to give an update on where they're at. It's primarily going to be used as a vehicle to talk about them, but I also want to use them as an example of how to look at a bank using Bankreg data. So let's go ahead and close this down, and we're going to jump right back here into Merchants Bank of Indiana. Their ticker symbol is MBIN. We can see here in the upper right, their asset growth has been considerable, but publicly traded entity. They've gone from about $11 billion to just under $19 billion in asset growth. And we also see during this time frame that their loan portfolios have gone up about $5 billion in 3 years, which is a lot of loan growth. A lot of loan growth. So before we start jumping into metrics, let's take a look at a couple things. First thing is the tear sheet. And this is going to be 54 metrics right up here. That break down into capitalization, liquidity, asset quality, charge-offs, income, net interest margin. Orange is going to reflect banks that are nationally in the bottom 20%. So 80% or more of the banks are better on that metric. And so we can see here a lot of delinquencies, 2.7%. Essentially, they are restructuring some loans. They have a high CRE concentration ratio of 385, which is very high for a bank in the Midwest. We see they're starting to eat some charge-offs, and they also have some liquidity issues. We see a lot of orange over here in terms of low cash, 3.23%. Loans to core is exceptionally high at 152. And at the end of the day, they're not extremely capitalized. Tier 1 capital of 11.39. Notice how CET1 is 11.39 and Tier 1 capital is 11.39. There's this perception there's a big difference. There can be for the biggest banks, but for the vast majority of banks, 97% of the banks that are reporting risk-weighted assets, they're identical. There's no difference between Tier 1 capital and CET1, and that's illustrated here. Scrolling down, look at our Century Event Engine. We see that they're starting to have some issues in their multifamily with their early stage jumping from 56 million to 165. I'll click into Century a little bit more, but we see early stage delinquency issues, we see performing, and we see that they're starting to also shrink their portfolios, primarily construction, non-owner. But notice they're taking some REO in commercial real estate. So a lot of things that we're seeing in terms of the pipeline of multifamily and CRE are problematic for merchants. Scrolling down, the last bit that we're taking a look at here is our threshold alerts, and they're lighting up like a Christmas tree. CRE concentration ratio we already identified. We see brokered, loans to core, high expenses. Those are all liquidity issues. They're also identified as high pledges, long-term assets, Federal Home Loan Bank advances of 18. These are all things telling us that this bank is struggling to get funding. But we're also seeing a lot of non-performing loans. So this bank is hitting the intersection of a liquidity issue as well as delinquency and asset quality problems. Non-owner occupied NPLs at 4.12, multifamily at 375 NPLs, early stage 4.85. So you're talking 8-9% delinquency rate in multifamily. And probably most disturbing here is their coverage ratio is extremely low at 41 basis points. So 41 cents of allowance for every dollar of adjusted NPLs. And we'll get into that a little bit more. So let's just start cycling through, right? What we're going to take a look at is go to Century proper. And here's that $109 million increase in multifamily. C&I is up 8.3. Now let's take a look at late stage, which is non-performing. We see once again multifamily. So multifamily is up 109 early and 41 late. We're starting to see some significant degradation in that portfolio. Non-owner occupied, same thing. Was 21, 21, 21. And so what does this tell you right there, right? Take a look at that and you see an identical dollar amount. Identical. So if it's an identical dollar amount, the dollar amount is indicative probably one, maybe two loans. 21.7 million for multifamily or non-owner is not very much. Could be one loan. But when you see an exact dollar amount for 5 quarters in a row, it tells you they're not making payments. So either they're not making payments and they should have been charged off well after that time frame or during that time frame, or there was an arrangement where it was interest only. But if it was interest only, then they wouldn't be on non-accrual. So we can look at that as well. But regardless, it went up 15 million and then another 12, and now it's up another 25. So we're starting to see a considerable degradation in their essentially CRE portfolio. Other events are going to be TDR, allowance. What we're seeing here is a very large increase of $2.4 billion in FHLB advances. The commercial real estate REO is 900, so it's not massive, but you're starting to see an increase there. Core deposits, they're not having a problem getting deposits. They're paying a lot for them, but apparently it's not enough for them, right? They're having to basically take more FHLB. So let's go back to Bank Home, and we're going to take a look at CRE concentration ratio. And for a community bank in Carmel, which is actually a really cool town, it's a suburb of Indianapolis, beautiful town. But basically, for a bank in the Midwest in this kind of market to be running 450% CRE concentration ratio is too high. That's going to be your multifamily, your construction, and your non-farm, non-res, which is non-owner. And so you can see that number got real high, and now it's starting to come back down. And I'm guessing they were told that number has to come down. What we are also seeing is a lot of increasing activity in mortgage banking activity. This is one of the reasons rates go down at the beginning of recessions is one, you're trying to basically get interest expenses down for banks so that money can basically subsidize losses through provision and allowance. But also non-interest income help can do that through mortgage banking activity. And so we can see that they're starting to ramp up. A couple of quarters ago, they were doing 50 million and they were doing 50 million origination, 50 million in sales. Numbers gone from 50 to 80 to 120, 50 to 70 to 125. So this is going to prop up their income statement quite a bit, and so we'll come back to that, right? How much of their income is basically being generated from this mortgage banking activity? And realistically, we could have seen this. If I would have taken a minute to walk through this, this is the number of FTEs. And you would expect FTEs to go up as you have more assets, but you would also expect FTEs to grow substantially if you're ramping up your mortgage banking underwriting. And that very indicatively is from 591 to 615 to 643. So whenever you see staffing go up, always make sure to take a look at mortgage banking activity, see if that is correspondingly the case. So I'm curious. Let's jump into income and expense. And we're going to basically come into pre-tax net operating income. And we can see that number looks remarkable, right? It looks really good. A lot of blue. What is blue? Blue is basically going to be compared to peers. And they're going to be the 99 closest banks on asset size. So this number is still probably going to have some fluctuation in it as more banks file. But man, 182 basis points, pretty good. Come down here. Basically, it looks good historically. Come down here. 75% of the banks that have filed so far are lower. So they're in the top half. Their income looks fantastic. But how, right? Really, I should be looking at tax equivalent, but for this is a publicly traded bank, it's going to be somewhat similar. Let's go in and take a look at non-interest income. And we're going to basically take a look at loan sales activity. So you can see how they've been ramping up this underwriting and generating more income. So $4, $5, $6 million, up to 10 million, up to 13, 14, 16. So it is now becoming a fairly significant chunk of income for them is basically coming from some kind of underwriting, mortgage banking activity, some of it, but they may be doing other things as well. But basically, we're looking at $83 million is the lowest number they've had in a little over a year. So income looks great, even though we were seeing a lot of liquidity issues and a lot of asset quality issues. So let's go back and take a look at this. I'm going to cycle through, and we're going to go to loans 2012, and we're going to see over here loans growing. I'm an underwriting guy. I'm a collections guy. That's what my background is. And whenever you add $5 billion of anything, you're going to have some delinquencies associated with it. And that's what we're seeing here in the red is the delinquency rate was going up considerably, slowly, then up, then slowly, and then a big jump there, 95 to 149, then slowly, and then another big jump. Things, especially for bigger banks, right? You start getting above 5, 10, 15 billion dollars. There's not going to be this one or two loans makes the world fall apart thing, but it starts to be a cascading series of issues. And this bank has been getting worse. And this most recent activity is considerably worse, right? I mean, we're seeing a huge jump in the delinquency. But should also catch your eye is this restructure, this orange chart on the right. It's gone from 0, 0, 0, 0 to now all of a sudden they're starting to restructure debt. So we'll have to see if they're putting that on non-accrual, what's going on. Popping down here at their portfolio, we see $5 billion of all other loans. Makes up 35% of their loan book. No non-performing loans. So what is that? It's always non-depository financial institutions. But let's look. $5 billion. How much are state munis? 0. How much are purchase carry securities? 0. How much is non-depository? Almost every penny, right? Almost every single penny of that is NDFIs. So this is going to be loans to mortgage wholesale warehousing, consumer warehousing. They could be lending to non-bank lenders, truck financing, leasing agencies, small business lenders. The belief is there's no risk with those. I'm less skeptical. We'll leave that for another discussion. I think there's going to be a lot of trouble in the NDFI space. But when we come back and you know that so much of their growth is in this NDFI area and the expectations are they don't have to carry a lot of capital and a lot of reserves for it, when you come in and you look at their reserves, it gets complicated. So we're going to go to asset quality. We're going to go to look at allowance, which the numbers are atrocious, right? They look really bad. 58 basis points. Well, remember, part of that is a third of their loans are going to be NDFIs. The regulators don't require the same level of allowance for those, although I think that's going to change. There's going to come a time. So you have to be very careful looking at allowance. What you really need to look at is coverage ratio. And what this shows is for every dollar of allowance, for every dollar of adjusted NPLs, how many dollars of allowance they have to cover it. And so what we can see is they're desperately trying to increase their allowance, right? That number is climbing, but look how quickly their adjusted NPLs, 67, 82, 129, 141, 205. They have 41 cents. This is incredibly low. It's lower than they've been in 3 years. It's low compared to peers. It's lower than they've historically ever been. You're never seeing it at 41 basis points. None of the other banks their size nationally, looking at all the other banks nationally that have filed so far, they're in the 98th percentile. This bank is not reserved. It's just that clear, which is shocking considering they're showing so much income, right? You're showing tons of income, but they're basically not setting anything aside in provision. Just the provision. Blue means low, right? Blue means better than peers. But we see this bank stacking up tons and tons and tons of increasing NPLs, and they're just not reserved, but they're using that money to prop up the income. So their income looks great, but I'm telling you that the fundamentals are deteriorating quite quickly. So scroll back down here, and we see that all other, here's the multifamily, 375 basis points of NPLs, 412 for non-owner occupied. Those are the two portfolios that are giving them the most trouble. So come into multifamily. We see they grew that portfolio $1 billion in 3 years on a $2.5 billion base. There's your early stage delinquencies getting hideous. And there's your non-performing loans. We already saw this from Century, if you remember. How much of it's on non-accrual, how much is on 90 days. So you see at one point, they were trying to keep it off of non-accrual, but they eventually had to jump it right back on right there in that increase. Are they modifying loans? Yes. Are they putting them on non-accrual? So let's look at that. $76 million have been unmodified, 45 million isn't performing, 30 million in non-accrual. So right here, we see they modified 89 million and then it dropped to 45. How much do they have on early stage? None, which they shouldn't. How many do they have on late stage? None, they shouldn't. How many do they have on non-accrual? So what you have to ask yourself is, all right, 88 million was performing, 31 million was put on non-accrual. So some loans they said we're going to put on non-accrual, which means we pay down 100% principal pay down. But how did this number drop? How did we drop from 89 million to 45 million? And so when you're looking at TDR, it's modifications, loan mods, TDR, troubled debt reporting or restructuring. Always try to get a feel for why. How did that number fall? Because once you modify somebody and you left it off of non-accrual, did it go subsequently delinquent? So we're going to look for a $40 million increase. No, no, no. Did it get charged off? Doesn't look like it. Did it go to REO? So we're going to go to assets. We're going to pop in. We're going to look for REO. No. So the only thing that could be happening in this scenario is we have to ask, did it basically get sold? Did it basically get sold off? And so we don't know if that's the case or not. But when you see that drop there, you have to ask yourself, where did that go? It doesn't just disappear in one quarter. So anyway, looking at this, we're essentially seeing a considerable degradation in their multifamily portfolio and their non-owner occupied portfolio. So this bank is having some serious issues. Delinquencies are getting bad for them. They are struggling to basically, they're showing great income, but they're incredibly under reserved. So there's going to come some ramifications for this bank when it comes to increasing the likelihood of them maintaining good profitability moving forward is going to become problematic as they start to increase in charge-offs. Appreciate your time. If you have any questions, please feel free to reach out. Thank you.